Hi, I'm Keith McCullough. Welcome back. I'm here with Darius, who's a senior analyst here on the macro team with me. Throughout the day, he and I are back and forth on what it is that we're going to make calls on next. He's the guy basically who makes me look smart throughout the day on Twitter if I actually ever say anything smart. So with that, we want to talk about something that you can or cannot be smart on, which is emerging markets. So, emerging outflows. This is a big theme that we've been talking about throughout the year and earlier before they started to go down. And what I wanted to first do is demystify that a little bit in terms of our views. So, Darius, what is the most basic thing that we want to communicate to people in terms of why we would be concerned about emerging markets?
In one word, or one phrase rather, carry trade. Emerging markets are a carry trade that is unwinding. And the reason it's unwinding today is because two things. We see the U.S. dollar appreciating here over a sustained period of time, and we see U.S. interest rates backing up over a sustained period of time. And what we think will happen under that scenario is a tightening of monetary conditions throughout the global economy, which will weigh on emerging capital and currency markets over the long term.
So a lot of this has to actually do with the U.S. It has to do with the U.S. dollar and U.S. interest rates. I think when people typically think about emerging markets, they think about emerging markets. They
Absolutely.
Don't think about it from a currency perspective or the relative currency perspective or the relative interest rate move. So how do we just boil that down for people in terms of where we go from here?
Well, I would boil it down to this. What even is an emerging market? An emerging market is something that's marketed to investors via mutual fund prospectus, via hedge fund prospectus,
right.
And it's sold and packaged as a bill of goods, as a security or asset class that only goes up over time. Mm-hmm. But when you pull back the charts and pull back the curtains 30, 40, 50 years, you start to realize that emerging markets have these humongous up cycles and these very sharp down cycles over time. And traditionally, those down cycles are accompanied by a rising U.S. dollar and rising U.S. interest rates as the U.S. economy improves rather than gets worse.
So it's really the carry trade in many regards is also a big beta or a leverage trade on a lot of the things that we've been going through for the last 5 years, which is down dollar, down interest rates, big Ben Bernanke. Is a lot of this really having to do with Ben Bernanke himself?
Well, absolutely. I think the taper talk, or as consensus has decided to call it, that's really weighed on emerging markets to date. But I think the real issue with emerging markets and emerging market investors and their portfolios over the long term is just a return to normalized monetary conditions in the U.S. Could the U.S. economy start to sustainably heal over the long term? Certainly, that's our call, and it has been our call from a macro team's perspective. And will that weigh on certain emerging markets? Certainly. We've seen that in Indonesia. We've seen that in India. We've seen that in Brazil. We've seen that in a ton of economies. And we think that's a story that's here to stay, Keith.
So if the Fed tapers, really what they're doing is tightening financial market conditions is what you're saying on emerging markets, correct?
At the margin. And as you know, and as I've learned from you, Keith, that everything in macro happens, that everything that matters in macro happens on the margin.
Oh, it's interesting. So Ben Bernanke is just like wildly popular in emerging markets. I must imagine
he's total rock star.
Rock star? Like
no, he's more popular to emerging market investors. He's made a lot of people rich debauching the U.S. dollar and lowering U.S. interest rates over the long term. If we get a Larry Summers in there, and we all know Larry Summers, if he gets in there and he says, you know what, I'm tired of emerging markets going up, I'm tired of the dollar going down, it's gonna hurt.
I think that's the subtle but not so unobvious point to people. I mean, people don't equate emerging market commentary to dollar commentary. So any relatively hawkish commentary from Larry Summers would be just that. It would be bearish for gold and bearish for emerging markets. Now, what emerging markets in particular are the most bearish, and can you just blanket the whole thing, or do you pick them?
I think the worst thing you can do as an analyst is make a blanket call. And I think the worst thing we've done as an industry over the last 10 years is sort of loop emerging markets into this sort of gigantic asset class that investors need to, be diversified into.
Well, it's crazy. The emerging markets ETF has non-emerging markets in the ETF. And like, isn't South Korea the top weight in the emerging market?
Absolutely, absolutely.
Is South Korea an emerging market?
Have you been to South Korea? It's certainly not an emerging market from my perspective. It looks like a developed market. So, we created a model to sort of to separate the winners and the losers in this scenario. South Korea is one of those countries that screens very well on this model. The countries that screen very poorly on this model, be it India, Indonesia, Brazil, Peru, all these sort of Latin American and even African commodity producers. And one of the things that debauching the U.S. dollar has done for these markets over the last sort of decade or so is made the cost of capital cheap, and it's made the supply of that capital very, very abundant. And that's caused their growth rates to grow, and particularly countries that are linked to commodity exposure, they've been growing very rapidly, very faster, much faster than they would have grown otherwise in a stronger dollar environment. And we see that, that scenario about to take off.
Well, it's interesting. Like, one of the most interesting charts you've given me in my own education here is the all-time high in Asian currencies versus the dollar. That was 2011 because, of course, the dollar hit a 40-year low in 2011. And you also saw the highest growth rates from a GDP perspective at the same point. So it does line up with kind of the best for emerging markets being in the rear view. How low can emerging market growth go in a place like India or Indonesia?
Lower. I think that's the answer. on the margin. If you pull back, get IMF estimates, World Bank estimates, sell-side estimates, buy-side estimates.
Well, all the estimates we start with when we make a decision.
Exactly. All these estimates are streamlined 10%, 5% for here on to 2030. No one knows what's going to happen in 2030. You can't tell me with a straight face what's going to happen tomorrow.
I got to disagree with that. I think when God created Earth, he created the IMF, the World Bank, and the Fed, and they were all going to streamline the estimates.
Very smooth.
Smoothing. They call it smoothing. These folks can also smooth the economic cycle, folks. But anyway, so the reality is it's not going to be smooth, and the slope of the line, which again is what matters to us most, you're saying it's just going lower.
It's going lower, and it can go lower for a long period of time.
And what would perpetuate that? A weak currency?
Weak currencies perpetuate inflation. They perpetuate capital outflows, and capital outflows perpetuate slower growth. It's a reflexive cycle.
Now, a raging Keynesian economist would tell us that a weak currency perpetuates exports. Now, that, of course, didn't happen here, and it hasn't happened anywhere else, for that matter, as of late. So when I saw the Indonesian currency having its worst down days ever 3 weeks ago, did that stimulate exports that day, or how did that go?
Yeah, they were exporting capital back to the U.S.
They're exporting. Well, that is back in the day in Bolivia, they exported cocaine, and they imported U.S. dollars too. So I guess that's another way to think about emerging markets.
Certainly, that's neither here nor there. Actually,
well, there's a lot going on there when you run out of things to export.
Exactly.
Well, that's that. There's a lot to talk about here, folks. And when you boil it down, we don't want to be long emerging market debt. That would be the first thing that you don't want to touch with a 10-foot pole. The other thing is an emerging market currency. We don't like those either. And then when you get into the equity part, you got to be selective. So as Darius pointed out, we'd like to be potentially long here. South Korea, if we get the right price. We don't like India, and we don't like Indonesia on the equity side as well. So thanks for tuning in. If you want to follow us or tweet at us or do anything. At Keith McCullough is my Hedgeye handle, and at Darius Dale, he's the man right here to go to on that front. Thank you for tuning in. We appreciate it.